All right, good evening, everybody. This is Ken. This is the online swing trading workshop webinar for March 6th, 2016. We're going to follow this agenda. I'm going to start with a review of or a preview of next week's homework and then this week's homework. Make some comments about message traffic in the work groups, answer any there were a couple lingering questions from previous weeks in the FAQs, which I will answer. I have a number of good lessons from this week, some insights. That's where we'll take a break. And then I'll do the review of the trades from the last week's frames and the management strategy, and then also some report signals from this week's report reading. I've already completed that video. I've hung the link on YouTube for you, and the link is in the chat room. It's on the channel, and it's in the right board for you. And out of that report review, these were the symbols that I became interested in, and we're going to take a look at most of those. There's some like ABGO that just it's not on my radar screen. It was interesting in the report, but it's not one of the ones I normally trade, so I don't have a trade frame for it. We may get to it when we get there. But all the other ones are part of the usual suspects, and so we'll take a look at all those. All right, so on with the show. Let's see, we're recording. Okay, so the first thing I had was to review was the homework that was due for this week were midterm student reports. There were 4 or 5 that got accomplished. I've taken extracts or summaries of those, and I'm going to get to them later in the briefing. So this is homework 0502. So that's going to roll forward for you. If you haven't done that one yet, what I would like you to do is complete that one so that you can do homework number 1 for this week, which is I want you to identify high payoff areas to concentrate on for the remainder of the course and update your workshop goals. So at the start of this, we had to do individual goals. And so this is the midpoint correction. So in order to do homework number 1 for week 6, you really have to complete homework number 2 from this week, which was prepare that 1-page summary. And again, we're looking for the usual things, the best things, the hardest things, aha moments, best takeaways, biggest unanswered questions. Those should be things that come out of your review of your learning journal. So I'd like you to summarize it in those 5, and I'll show you some examples of that today. And then I would like you to then carry on and sort out what you want to do for the remainder of the course. This should read homework 602. The next homework would be to take a look in the daily report. There is the report page on the regression line fractal framework, and it has a write-up on it, and I mention it like every week of what that report does. But what I would like you to do is pay close attention to that one and see if it's clear, or if you have any questions on it. If there are questions, I'd like you to have those noted by Wednesday so I can determine if I need to do another video on that one. And then right after the fractal framework page in the daily, there's a thing I call the daily squeeze. And I would like you to also review that report page. And again, by Wednesday, identify any questions you have with the write-ups from the daily report to see if you can get your arms around those 2 strategies. Those 2 strategies are among my favorites right now because they are both straddling the swing trade time frame and the day trade time frame. So I think they are both very well suited for finding low-risk trading ideas that can be adapted and implemented very easily on any given trading day. It doesn't require any particular pattern. Both of these are based strictly on trade location and characteristics, the characteristics of the move. So that makes them strategies rather than systems. And so there's a write-up on the page in the daily report. So I would like you to review those to see if you have any questions. If we have a little bit of time at the end of this, maybe I'll just go ahead and give you the summary to make that a little bit easier. But I would like you to get your arms around that one. So those are the three things for this week coming up. Complete 502 if you haven't, the top 5 things. And then your updated workshop goals and areas that you want to focus on for the remainder of our time. And then a study of the regression line fractal framework and the daily squeeze. Questions on those, on the homework for this week ahead? Robert's question was, what were the 2 systems I favored? It's this homework 602, the regression line fractal framework and the daily squeeze. Those are 2 pages in the daily report that I would like you guys to look at and see if it's clear or not. I should have just opened the page and just gone right there. So this is the first page that I want you to look at. This one describes the regression line fractal framework. It has just a little bit of text, and it has 2 different categories. The ones in green are the ones that are the most ATRs below their own regression line 270. And so that makes them deep value plays. And the main idea, since I have some room to sketch on this, I might as well just go ahead and give you this summary now. So if we have the RL270, we're going to array it as this line right here, the RL270. So let me put it in the correct. You always see me show the 270 as like a pink line. So if that's the RL270, that's the long-term regression line that best describes price over that on a daily basis. That's like 13 months. And as long as price was kind of in a very tightly constrained channel this whole way up, you can see right now the way I've drawn that, the RL270 is a very good description of the current fair value. That means the current price is also right where the long-term holders believe that is fairly priced at. There's no deviation between short-term and long-term. So the idea behind this came out of when we were short-term trading, looking at the 30-day or the 30 period and the 10 period regression line. And we said that when the 10 period regression line, which follows price, if things are moving along like this and then price suddenly breaks down, the 10 period regression line in blue follows it pretty quickly. And then the 30 period regression line follows it, but more slowly. And it looks like this. So you get that, you get price, then you have the 10 period, and then you have the 30 period. You have this little divergence. Well, when that excursion away from long-term fair value happens, and by long-term fair value on this one, I mean the river rolls and keeps going. And we know that 30 period regression, or the 30 period moving average, the middle of the river, is slower to change than the 30 period regression line. So if it turns out that the price had a great big divergence, eventually the river will roll over. But the price, the 10 and the 30 regression line will all follow price much sooner. And it'll do that until price starts to reverse and moves back towards the river to get a drink, if you will. Well, when that reversion back to the longer term trend happens, this is the behavior that you will see in the regression lines. The 10 period regression line turns and changes pretty quickly because it is very adaptive. And then there will come a moment when it's moving up with price, and it crosses the 30 period regression line, and that creates the RLCO condition. And when that is outside, and I'm going to draw the river around that Bollinger Band now, around the 30 period moving average. When that RLCO happens outside of the river, you now have a tradable moment, as this thing is going to try to go back to the 10 period regret, or to the middle of the river. Right? So the middle of the river is sort of our first target after we get that RLCO condition. Well, as we started trading this on different time frames, we saw that this relationship between the fast regression line, which is the 10, which is a good proxy for price, and then the slow regression line, which is the 30, this set up this fast-slow relationship in the same way that moving averages with fast and the slow can be tradable. It just so happens that the regression line is really another name for a least squares moving average. It just turns out that that's a much better moving average to describe price than a simple moving average, which lags, or an exponential moving average, or any other moving average you want. So I like that pair. So became accustomed to looking at the fast moving average and the slow regression line. Fast regression line, slow regression line. If at any time during this you need to ask a question, please go ahead. So we have the fast and the slow. Well, one of the things that we wanted to do was to be able to look at multiple time frames. And so one way you can do that is simply change the time parameter on your chart and then go like from 3 minutes to 10 minutes or from 1 minute to 3 minutes. So my typical trades were happening on 1 minute, and so if I multiply that by 3, I go up to a 3 minute chart. Well, when we went from 1 minute to 3 minute and from 3 minute to 10 minute and 10 minute to 30 minute, we realized we're multiplying by a factor of 3 each time, just about. And what we saw was that this relationship between price, the fast moving average, the slow moving average, and the river, the simple moving average, was always constant, that there was a very useful framework had developed featuring these regression lines and the crossover moment and the reversion to the mean. And because I like looking at multiple time frames, one of the things I realized we could do was, instead of toggling back and forth between 1 minute and then 3 minutes and then up to 10 minutes, all I had to do, and then finally up to 30 minutes, all I really needed to do was add a 90 period moving average or 90 period regression line, and then the relationship between the 30 and the 90 on 1 minutes would be the same as the relationship between the 10 and the 30 on 1 minute. I said that backwards. The 30 and 90 on 1 minute would be the same as the 10 and 30 on 3 minutes because of math. And so I multiplied 90 by 3 and came up with 270. and I realized we had the following thing. When we took a look at it, we saw that the relationship between the 90 and the 270, this 1 to 3 relationship, gave us the same insights as the 10 and the 30, but what we could do is by putting all those regression lines on one chart, we could see what was happening on the longer term charts without having to change the chart settings, and now we were able to see multiple relationships over multiple time frames on a single chart setting. Check or hold. Does anybody have any questions about what I just said? Yeah, Dave, correct. It's 4 screens all in one, looking at one. So what we did, instead of having 3 different chart settings with different time frames, by putting all those lines on one chart, you can still see the same relationships, but without having to change the primary chart that you're using for execution. So let me clean that up here a little bit more. So this is the next insight I had. So if we look at these 10, 30, 90, and 270, we have a sort of fractal relationship now going on between these two. So we have the fast pair and we have the slow pair. The 10 is the fast, and the 270 is the slow. And so one of the things that we noticed was that the 10 is a really good proxy for price in any time frame, and that 270 could be used as a proxy for long-term value. And by long-term, what I mean is whatever the time frame you're looking at, if it's 1 minute, the 10-period regression line on 1 minute is what the current traders think the best proxy for price is right now. And then the 270 period is what a long-term buy and holder, a large institutional money, would consider to be the longer-term fair value. He is not easily convinced by the gyrations of a trader. So traders tend to trade like this in these little short, jaggy moves. And a long-term trader wants to do this, and then when it's achieved a certain level and then crosses some threshold, this is where he makes his decision. But he's not really knocked out of his position by all these little jaggy moves until his own regression line rolls over, and now he's moved a certain distance down, a certain retracement from his all-time high, and that tells him, based on that move, that a sea change has occurred, and now he's out of that position. Check or hold. Everybody see that? Okay. So this was the next moment of insight. We said, let us just take as a given, for purposes of the framework, that that price is doing this, and then it will do this. And if we draw our regression lines, first we'll take the 270, and we'll say this move happened a long time ago. It will go like this. Then there will be a price deviation, as you notice. And when that thing rolls over, the 10-period regression line, it does a very good job of staying right with price the whole way. And what you'll notice at the same time, when you look back with a long enough look-back period, that it takes a long time for that 270 to roll over and then start playing catch-up. It starts looking like this. Everybody see that? That's the lag period of that much longer regression line. So that's what the long-term holders, that's what their decision curve looks like, what they think the true value of this thing is. The traders are looking at the current price. Now here's what we noticed. there comes a moment when on this run up, all these little moves, there comes a distance that the traders can move the price away from the 270, and then nobody else follows suit. Everybody else still is believing in the longer term value, and then price comes back up. And then it travels with a while. Sometimes it overshoots, and then it comes back this way. So you get this sine wave oscillation on either side of the RL270. And that there are certain moments in which price and the 10 and the 270 are all in agreement. And so I've come to think of those moments as when everybody agrees that is the current price, the fair value of that instrument. That's what the actual price is, what the traders say the price is, as revealed by the 10-period regression line, and what the long-term traders think based on the calculation of the 270. So in these moments that I've just circled, we have temporary agreement between the short-term traders and the long-term buy and holders. Check or hold. Okay. So now, if we were to draw a line from the 270 down to the peak or to the maximum excursion of the 10, away from that 270 line, we would say on this excursion, in case number 1, that's how far the traders were able to depress the price before they ran out of money. And then all of these long-term buy and holders who have been marching along with it all the way up see this as a buy on dip opportunity. They say, hey, this thing is great. Look, it's going up and up, and it's temporarily on sale. And so they tend to buy it. They come in with strength and capital, and they overwhelm the short side, the sellers, and then all that buying pressure takes on a life of its own, and they move it back up to what is the long-term fair value. When it gets back to the long-term fair value, then all of those guys who were going to buy on dips are over. And then maybe the only guys who are left are the fifth mice who say, oh, I guess this thing wasn't going to fail at all. It's now back to what is the long-term fair value. I guess it's safe to keep buying it. And then maybe the fifth mouse comes in and starts buying it. And then he gets some reinforcement from the traders. And now this thing overshoots the long-term fair value all the way up to the point where all of that buying disappears. And then it price decays and it comes back to the RL270 up here in this circle. And so what you get is in the long-term move going up, you have this stable curve of the RL270 that looks like the long-term fair value. We're going to define it as long-term fair value. And then you have at times a divergence from that on the basis of short-term traders. So now let's take a look at this moment right here. Here's a moment where we just had a significant move away from the RL270. And one of the things that we can do on the daily charts, and that's what we do down here, is on the green line, what we've done here is for the Dow 30 in the first column and then the ETF 100 and so on, is that we've taken the difference between the current price of the RL10, which we're calling the smooth price or the real price, and then the price as for fair value as computed by the RL270. And then we've taken the ATR for each symbol, and we've said how many ATRs below long-term fair value have traders been able to chase the price. And then the number of ATR tells you how much power the traders had to be able to move price away from long-term fair value. Check or hold. So now as a good second mouse, one of the things I want to do is I want to let the first mouse come in and start buying the excursion, and I want to start buying it when the price, I think the price is someday going to come back and catch up with the 270. If it comes back on this curve it's going to catch it here. If it came back all in one day, it would catch it up here. If this was kind of a slow rolling thing, it might only catch it way over here. And so as I start watching this thing go through time, what I'm going to do is when the time is favorable and it has started to retrace, and maybe there's a 1 ATR move off this bottom, I'm going to take, whenever that occurs, and I'm going to count how many ATRs there are to the 270 as of today and use that for my reward to risk ratio. How many ATRs back to the 270 compared to the size of the ATR risk that I'm willing to take? A minimum of 1, because we're talking about a swing trade. So now what I do is make that computation for everything in the Dow, and then we find the 5 that have the greatest number of ATRs below their RL270, and we tentatively call those the quality on sale. Now, it may be, and we will never know until time passes, until we will never know in the future, or we'll never know until the future, whether the RL270 is the fair value, or if the traders who are marching along here, now the traders figured out something and they brought it down here. Maybe this is the new true proper fair price that they discovered right here. If the traders were true, then what will happen is at some point in the future, the long-term traders are going to agree with them, and we'll see that happens when the RL10 meets the RL270. But sometimes the traders are wrong. Sometimes the long-term guys are correct, that they have more information or they're stronger willed. And in fact, maybe this is the long-term fair value. And if that were to be the case, then we would expect at some point the shorts can no longer hold those positions, and it's going to come back and link up in here. And it will turn out that the long-term traders were correct. Or they meet somewhere in the middle and discover that this is really the next fair value, and then price will be on this, at this price level. So this is price level 1 or 2 or 3, whatever you want to call it. But the answer to that question is always at some time in the future, t plus x, some amount of time in the future. What we can do is we can frame those trades and say, on the basis of ATR, so it's adjusted for that instrument's volatility, how many ATRs is it away from fair value? And then we can decide what is the minimum reward to risk ratio that we want to see before we're convinced that it's time to start trying. If we said we want to see 2 to 1, this thing might come back 1 full ATR, and then maybe we buy it here, and we have this idea of 1, 2, 3 ATRs. We say, all right, this thing could go like this. I'm willing to put my swing trade in. And then as this trade starts unfolding, if it's not following that line, the more it looks like this, the less and less remaining value there is, because now the long-term guys are losing their opinion. So the longer that it takes to get back to the RL270, the less and less favorable that trade is. But at the time we made it, it was good enough to take a risk. So we can use this regression line fractal framework as a way to dynamically estimate the reward to risk that's adjusted by volatility and updated by time. And we're basically trading on the difference between the opinion of long-term holders, the purple line, or the RL270, and the current price, which is short-term traders, the RL10. Check or hold. So I say all that just to say that now when we look at this page, on the bottom, this top shelf, these green numbers are the ones that are the most ATRs below their own RL270. And so I think of these guys, in this case, there's the RL270, and here's the price that is deviated. And so right now, AXP is 3.62 ATR, something like that, 3.62 ATR away from his own RL270. And now these ones on the bottom shelf, these are the ones that are the most ATR above their 270. So they will typically, the ATR is ATR 14, the standard, just the standard ATR 14. There was no, I didn't see any reason to get tricky on that one. But you can pick, really, you could pick any kind of unit of noise. You could use a frog box or whatever. I'm using ATR to keep it straightforward, because there's enough belief stretching on this one already. Yes, it does, Robert. I'm going to cover that in a second. So on this one, we might have had the RL270 rolled over and did this, and this happens quite often. You will see that price may have deviated, and then it found its bottom down here. And what you'll see on a daily chart is it will do its own RLCO. So the 30 would have done this, right? And the 90, which I always color code as a dark green, the 90 would look something like this. So then when price does improve, you will see it start to go up. You will see an RLXD, or a RLCO right here, where the 10 crosses the 30. You'll see that it crosses the 90, and you'll see that it crosses the 270. And when I see that occur, what I do is I go back and look at the previous excursions, and I say, this is how much the traders were able to move the price to one side of the 270. I then take that and I project this up and say, so this excursion is equal to that excursion. And I say, if they were able to move it this far this time, then they can certainly move it this far next time. And then using my purple line, I project that as the price target. So if I were to make this trade here, I now project that it could go that far for my price target to the upside. If it does that, here's what we would see. The 10 has turned, the 30 will then turn, the 30 will cross the 90, the 30 will cross the 270, and then the 30 will be paralleling this thing all the way up. And yes, you guessed correctly that the 90 turns and it crosses the 270. And so when things get going like this in a perfectly orderly universe, you will then see that because all the price ran all the way up here, that will usually be enough for this 270 to turn and catch back up. So you have almost this ribbon in space working. And so the regression line fractal framework is a way for us to look at the difference between the 10 and the 270 and realize that that's the difference of opinion between traders, the 10, and the long-term holders. Now, I call it fractal because this works on any time frame that you put on the chart. So if you look at 10-second charts, or 1 minute, or 3 minute, or 10 minute, or 30 minute, or daily, or weekly, or monthly, you're going to see these relationships hold true. And so one of my favorite intraday techniques is just to use 1 minute charts and only trade off of the 10 and the 270 and their slopes. So now, Robert asked the good question, does the slope of the 270 have anything to do with this? Yes, it does. All other things being equal, the slope of the 270 is the mood of the market. It is the mood of the institutional money. And when that thing is long and strong, it takes an enormous amount of effort to get it to turn. And then when it's going down, it takes an enormous amount of effort to get it to turn. So I think of this as the 12 o'clock position, because I think of this as the clock face. So 12, 6, 3, and 9. When I see the 10, which we array as blue. Whoops, sorry about that. Erased all the drawings. Nice job, Kenneth. And so here's my little clock face again. When that 10 rolls down to here, it looks like the 9 o'clock position. When it gets down here and starts to hook back up, I think of that as the 6 o'clock position. And so as long as the slope of the 270 is up, I really think the 10s are wrong, and that all we have is something that's going to turn around quick and try to catch back up to the 270. Once that 270 has rolled over, then my bias is onto the downside. And what I'm looking for is to get short excursions away from the 270 until those things can't happen long enough, and now it starts looking like this. That's what the excursions look like. And so the interesting moments are those times when the market is kind of sideways, and when the slope of the 270 has become compressed. Those look like the transition states between big down and big up. The market is directional in between those periods. Well, thanks to our good friends at freestockcharts.com, one of the things you can do is put an indicator on an indicator. And so it wouldn't surprise you to know that I like to put a Bollinger Band on the 270. So when the 270 looks like this is what the Bollinger Band looks like. Let me just take a thin slice of this. So at that moment, this is where the 270 regression line is. And so if we go back 270 periods and we find the average price is going to be right about here. It turns out that becomes the middle of the Bollinger Band. Of the river. So as long as that 270 looks like this, there is a Bollinger Band. It sort of looks like there's like a little river, and the 270 stays out of the river a long time. And it just goes on and on like that forever and ever. And then this little channel right in here, the vertical cross-section is the noise boundary around the 270. So now, when you get up here, and price action occurs, and this thing starts to get flat and then is going to roll over, this is a very interesting phenomenon. The Bollinger Band slowly gets very, very skinny and comes into here like this, almost as the Bollinger Band is as thin as a line, and then looks like this. And so once in this region right here, when the RL270 crosses its own Bollinger Band, now that is the signal. That's the transition state that says now it's downward. And then the longer this slope continues to get to go down, the wider and wider the Bollinger Band gets, and the wider this cross-section of noise boundary looks like. You call it the ribbon. It's fascinating. And this works on 10-second charts all the way up to monthly charts, although there's not a lot of things that have 270 months worth of data that you can do this on. But since we're talking about this idea anyway, let me just go ahead and show you what that looks like. This, by the way, is roughly a $10 million idea. There is no amount of algorithmic trading or fancy pattern recognition or neural networks that can affect the framework that I just described, because it takes into consideration price changes over very long time frames versus price changes over very short-term time frames, and then calculates the available reward or the inefficiency in terms that are volatility adjusted. So it's auto-adaptive, and it is indifferent to other patterns other than simple trade location. It is the best way I know to measure the psychological difference in the opinion of price in the minds of short-term and long-term traders. It's probably more than 10 million. This is a very large idea. I can retire on this idea, but I'm not going to. So let me show you what that looks like on a real regular chart now. This is kind of a divergence from the order we were going to go in, but this seems like a reasonable time to cover it. Might as well cover it now. All right, so this is a 1-minute chart on the S&P. I'm going to expand it a little bit so you can see this idea right now. So this only happens to be about a day's worth of information. Well, it's at least worth 10 million, Lisa. I mean, depending on the size you trade this at, this could be worth $1 billion to a large enough fund. Why does the band get wider as it goes further? Because of math. Because prices. Here, I'll try to show you why it is. The first thing I want you to notice is that up here, where it rolls over, this moment where it entered its own ribbon, so this ribbon, this gray ribbon, represents a 30-period Bollinger Band, plus or minus 1, on the 270 itself. So it's on the 270. Okay? It's not computed by price. At this moment down here, this thing is as wide as it ever could get. And the reason for that is that the average price between this moment and that moment, there's about 270, something like 270 minutes inside this. So it's about 4 hours worth of data. All right. So this is right around 3 p.m. And what it says is when price during this whole look-back period was only contained, this was the average price of that entire look-back period. And this is how varied that is. If this had been one straight line all the way up or all the way down, then the size of the data would have been very large, and that would drive the ribbon to be very wide, because the difference between the highest and the lowest would have been the greatest when there was a single straight line from top to bottom. And that makes the variation in price great. When it's very narrowly constructed, when price went sideways for 270 minutes, the amount of disagreement between all those prices, those 270 moments, is small. That would give you a very small standard deviation. So the Bollinger Band gets very, very thin. So when it's getting close to a turning point, the Bollinger Band gets very thin. Now, what I want you to notice is that here was a moment when price and the 270, let me open this up just a little bit more. Here is a moment where the 10-period regression line, which is blue, and the RL270 and price, all of that was in a very tight cluster. So everything was in agreement. And then the traders were able to push it this far away from that line, this far away from that line, this far away from that line. You see what I'm doing here? Finding the difference between the maximum excursion of the blue line away from the pink line. Let's see if I can make that zoom in a little bit better. Yeah, this is what I want to show. So when we look at it this up close and personal, the distance between the RL270 and the 10 was this much. That's how far they could move the price. And then this time, this was how far they could move the price. And then it came back to that close. And then the next time they did it this far. And I want you to note, here's where price came all the way back to the 270. So the whole idea here is that traders are able to make this move, and then when they run out of gas, the longer-term guys who say, oh, that's a buy-on-dip opportunity, and they say, I'm buying this thing on sale, they start buying it, then they overwhelm the traders who then protect their excursion, and then price snaps back to the long-term fair value, and this thing just keeps going up according to the opinion of the long-term buy-in holders. That's the main idea. So now what we can do is we can say, look, when the traders, when it starts to roll over, here's how far they were able to get it to move away from the 270. Look, price came all the way back up to the 270. Then they made an excursion away, and once that turned and started to go back up, you see how the 10 is starting to move up? It came up and joined the price here and here, and now it overshot it a little bit. So what we want to look for are periods of excursion away from the 270. When the 10 rolls over and starts to move back up, we can say, look, if it crosses, there's the RLCO. If I make my little RLCO entry right here with the stop right here, my target is this. And then as long as this thing is going up, it's favorable. When it starts going sideways, there's my RLCO exit. That's my trade. And in this case, in a matter of about 30 minutes, you could go from 200.64 to almost 200.95. So that's 30 cents in the S&P in a period of time from 115 to about in 145. That's 30 minutes. Well, that's because we're looking at 1-minute charts. Well, the reason I say that that this is important is now, if we turn this into daily chart, guess what we have? Exactly the same thing. Exactly the same thing. Not a different thing at all. Exactly the same thing. This is why this is worth tens of millions. This is October 2015. Look how far the traders were able to push price away from the RL270. And then when it couldn't push it any further, what did price do? Came back to the 270 and overshot it a distance, and then he couldn't take it away any further. And now look at this. You were ready to get short because look at the trend line. That's not even, and look at the slope of the 270. Your bias is to the downside. Hey, I will tell you, Patrick Birch, I wish I was your age and I knew this. I wish I knew this when I was your age. When this thing finally fails here, you say, if this fails, how far can this go from the 270? Well, the last time, this is how far the S&P was able to fall before the plunge protection team was able to step in. Let's see how far that was. 187, 208. That's $20. That's 10%. Here's where it collapsed this time. And now you notice that the RL270 came through his own ribbon. See, it's in this downward move, it was below its ribbon. In this sideways move, it got even, and then it got below its ribbon again. So now once it collapsed, how far from here can it go? Let's just take it 10%. 184 is what you would expect. Guess where it goes to? 184, 10%. And so now on this move here, here's the RLCO. Here's the RLCO. You get one trade, you get two trade, and now it's back to the 270. Now this is why I think that there's reason to believe in the possibility of a change in market psychology right now. Because not only has price gotten back to its own 270, but it has gone through its noise barrier on the far side of the Bollinger Band mean. And even though we're only at the 200 period moving average, we're no longer in the bear. This is the start of a bull. This is the potential start of a bull. And I say, now, how far did it go below its 270? From 198 to 183, that's $15. So this is where it crossed the 270 at 195. You go up $15. This thing can go to 210 on the basis of the strength of traders who moved it this far. So now if this thing goes from 200 to 210, that's only a 5% move. Sorry, 5%, not 8. That's a 5% move. It can go, at 210 is the previous swing high. And if it gets above there, there is no resistance at all, and off it goes. So it's only $10 away. Now, that's what I mean by the regression line fractal framework. So that was now looking at a daily. This is a strategy for framing trades. All you got to do is compute. You can now study what's the greatest distance between the 270 and the RL10 over time as expressed by ATR, percentage. Now what I can do is I can compare a stretch stat, or I'm going to call this the swing stat. It says the average distance that it gets away of all the times you can draw a histogram and put some standard deviation bands, and you can say, oh, this was a very favorable stretch of price away from the 270, and this is a move that is extraordinarily stretched below the 270. And then when you see the market start to turn in either direction after one of those moves, you have a powerful signal to play a reversion to the mean trade. So not only does this give you the idea of how far it can move, but it also gives you an alert well in advance about probable locations for the market to turn. That's why I wish I knew this at age 35 or 30, however old you are, Patrick. This is a really powerful idea. I may have mentioned that before. Very powerful idea. $34. So on this little on this little sheet right here, in a half a page, right there, this is a freaking gold mine, because you now have the Dow 30, the ETF 100, the S&P 100, the NASDAQ 100, the S&P 500, and these are the 5 that are the most above their RL270 in terms of ATR. These are all, so these are the ones that are below. These are all the deep value plays, and then these are all the winning relative strength plays. So let's take a look at the difference between AXP so when we look at AXP and Verizon, we're just going to take a quick look at what the difference on those looks like. So AXP, ladies and gentlemen, I rest my case. Where should we get, should we be getting short on AXP right here? Why? Because the 270 is down and it's hitting lower lows and lower lows. It was, in this entire period, the signal was get short. And when it falls below, and each time that it goes below the previous swing low, it's a signal of greater failure. This is where you get even bigger short. And then when it solidifies, you get even bigger short. And here, even bigger short. And now look what happens down here. This is where you got a potential RLCO signal, but it didn't follow through. Instead, it failed, so it's an auto short. You were playing this as the long side, but it failed, so it went there. Now we get an RLC over here. It didn't follow through, so you could get short. But now look at this. The 10 has sloped up. Look at the 30. The 30 is now at the 6 o'clock position. So if this was 9, and this is 6, and this is 3, this is what you love to see. The slope of the 30 is up. The 10 and the price are already going. And look what we did with our swing trade patterns from last week. Looking at our regular candlesticks and framing the charts, we ended up with this much risk on this low-risk trade. And by the way, this is a sign to, if it fails, that's an auto short. But right now you have the 90 has crossed the 30. We're well in the money. The 30 is above our entry level. And so we're holding 58.30 on an entry of 55.20. So that's plus $3 on about a $3 stop. So we got 1 R into this thing. So we're holding 1 R. And then we can estimate fair value on this. You know, this is a swing trade workshop all of its own. Just that one freaking idea. I can't believe it. What am I doing? So at this moment, when we entered, the trade target was here. And now that we're over here, it's here, has a reasonable place. Because there was a lot of reasons why AXP had failed this far. Remember, we're still bucking the curve. there's a lot of long-term guys that really don't believe that this thing is any good. This is all tactical traders that are still following through. First mice, second mice, and maybe some third mice. But don't make any mistake. The trend on this thing was down. This was the big shakeout to shake out the weak hands, but this is still very dangerous territory. The market itself is only at the 200-day moving average. And so we're holding an R in hand at 58. It's only one more R to the adjusted 270, and that would be our 2R. So we're not going to add a position until this thing gets through the 2R. If I was conservative, I would wait to see if I saw price above 67.50, the far side of this ribbon, which is the Bollinger Band on the 270, that's where I would add a second position. I'll have almost 3R in hand if that happens. But in the meantime, I'm not going to let this thing turn against me and go negative. I've got an R in hand. Are you kidding me? In a bear market, went long on the weakest sector, and we're holding an R with the potential for 2, and then a place to double up and scale. I'll take that all freaking day. That is how you get an edge in the market. That is how you distinguish yourself from the herd. Where is the herd? The herd is this purple line. Where are the traders? The little psycho nuts? That's the blue line. That's the price. I wait for the first mouse to make the turn. I like this because the 10 made a double bottom. Take the second signal. Now the slope of the 30 is up. I'm the second mouse now. You're never wrong to wait until the 30 starts making an upward move because you still have this move. This is a much more probable move than trying to get this move. Look how many times that 10 failed and failed and failed. Oh, now it worked. Use the 30 for confirmation. Use the 270 for target. Look at the difference between the 270 and the 10 to compute the size of the potential reward. So that's what AXP looks like. And now we said the one that AXP, even now, AXP on an ATR adjusted basis is the most ATRs below his own 270. That's this right here. Even right now, that's the biggest ATR discrepancy between the 270 and the 10 in the entire Dow. So now let's look at Verizon, which is the strongest in the Dow. How do I know that that's true? Because over here, Verizon is 8.3 ATRs, 8.3 ATRs above his 270. So let's see what that looks like. Ladies and gentlemen, I rest my case. Now here's what you can do. When you have these conditions like this looks like sideways quiet channel. Look, you got the 10, the 30, the 270 in a tight band and everything is sideways. And you say to yourself, hey, that might be the case where if I make a new swing high, this is the price that I expect it to fail at because that's the last time it went up to here, it failed. So if it gets above this, I can get long here. We had an RLCO on the far side. It didn't fail back to the 270 like it should have. It found support and kept going. Our little swing trade patterns caused us to take an entry right here. And now we're in this position. It's free and clear. There's nothing within sight for resistance overhead. We're at a 2-year high and going. You're afraid to hold Verizon? Then you're going to be just afraid. So not only can we play reversion to the mean, we can also play excursion from the mean. You can go back and compute the size of the moves away from the 270 and then go out one standard deviation in either direction and say, no matter what, that is a reasonable target if this thing departs the station, a one standard deviation move away from the mean. Have I mentioned that I think this thing is worth tens of millions of dollars, this idea? That's why. Okay. So that's homework number 1. And we've been going at it for 70 minutes. Where does the time go? Where does the time go? I do want to thank you guys for trusting me enough to pony up to the bar and make me do this, because this is what's forcing me to record these, and it's going to pay off for a lot of people. So I genuinely appreciate your trust in me and the encouragement you give me to get this stuff moving. This idea is very robust. So that's the regression line fractal framework. Your homework for this week is to read that page, to listen to this portion of the video. I'm going to extract this and just turn it into a 1-hour discussion. It's its own standalone movie. And I want to make sure that you lock in this idea this week, and then we'll be good. Then I'll feel like I will have done my job. What I would like to do is very briefly cover the daily squeeze, which is the next page on the report, and show why for folks that want to swing trade one day at a time, this is a particularly powerful idea, but for short-term pops. It's a way to get into things on the first day. On that first day when you get the favorable excursion from a congested zone, this daily squeeze is the next idea. It's what you do before these things have left the station. So let me shift to that real quick now. Here we go. Okay. Yeah, Robert, I would call it the minimum expected excursion. And we're going to call that one standard deviation away from the 270. That we're not allowed to be surprised if it moves 1 SD away. Okay, so now we're going to talk about the daily squeeze. This is your second homework for this week. So I'm going to read it out loud. So these are targets that have become compressed on a daily basis, and they have a large potential intraday move compared to the size of yesterday's range. So this is a squeeze. This is a coiled spring. This is the idea behind this move. In the previous, so the first thing we're going to take a look is, what do we mean by it's compressed on a daily basis? And I'm just using as a default setting 0.7 of the average range. All right. So we go back, and that's over the last 30 days. So we had 30 days worth of data. This thing looked like this. Had all this different. It doesn't matter what direction. It only mattered the size of the range. So we had 30 days of range to consider, of 30 individual ranges. So from that, we find the average range, Now this is a first cousin of the frog. In order to compute the frog box, what we do is we simply look back, and the frog box is the standard deviation in the differences in the sizes of the range. And then a range stat, which we define as the maximum reasonable range, maximum reasonable intraday range. We define that as the average range, so average, plus the standard deviation. And so our hypothesis is that if we saw price, which I'm going to draw a picture as green here, if price had opened here and then sold off during the morning and then starts, now we're 2 hours into the day and is starting to move, and we say, oh, this thing has moved a frog box off the bottom. How far could it go? We're not allowed to be surprised if it goes all the way to one range stat, which is the average plus the standard deviation. So that becomes our maximum reasonable intraday target. That's how much we can target intraday. So let's put some of these ideas together. So now what I'm looking for is something that was squeezed on a daily chart, which I define as 0.7 of the average range. So what happened was on the day before, it had a very small range relative to the last 30 days. This thing was only 0.7, but it has a large potential intraday move, and that way we're saying the yesterday's range compared to a range stat move is very favorable. So the best one out of the Dow and the ETF 100 is LMT. I don't even know what that is. But it has a range stat divided by a range risk ratio of 3.5. So it has, if we saw an orderly open and then it took out yesterday's high plus a nickel and then made a range stat move, and all we did was use yesterday's low minus a nickel as the risk, this thing has a one-day 3.5 to 1 reward to risk ratio. Lockheed Martin. I guess I should know that since they're the war pigs. So let's see what that looks like on a daily chart. This is the opposite of the 270-10 regression line fractal framework. This is just something that compressed and then has the opportunity for a one-day big pop. So let's just go look at Lockheed Martin and see what that looks like. LMT. And now I have to go back and look at my regular candlesticks in order for this to make sense. Now let me shift to a daily chart. So that's about 30 days worth of data. So what I want you to notice is a couple things. Compared to the last 30 days, this little rascal had a very tiny little range on Friday. And if it just moves, and if we frame the trade in the following way, like if we were to excuse me, pen. Choice of pen color is green. If we bought it 5 cents above and we put our stop 5 cents below. If this thing breaks out and we put a range stat move here, we would get 3.5 to 1 on an intraday move. So this is a one day, almost like it's almost like a daily frog, I would suppose. This thing is postured. It's a coiled spring ready to go. It's a frog in hiding. This is something that is just ready to pop. Now, what makes this especially attractive for Monday, and we'll take a look at this next weekend to see what it did, is look where it is postured inside the RLCO framework. You have the 270 just left the river. You have the 10 outside the river, price outside the river. The dragon just swam to the far side of the river. It's already at fair value, and all it has to do is get above this 220, and this thing is off to the races. That thing is perfectly postured for follow-through, if and only if it goes. Now, we know it could also fail at the 270, so that's why we want to see intraday price action that has it taking off. And I like the fact that the RL270 is up and the river is starting to slope up. This thing, you're catching this thing early in its excursion. If you wanted to use that last idea, how far could this go above the 270? Watch this. This is how far it was able to go below the 270 and below the 270. So it can go that high above the 270. That's your profit target, 227. Because that's the same distance as you have right there. So that's what that little daily squeeze idea does, is it finds things that are postured for a big surprise move tomorrow. It's the coiled spring. It's the frog getting ready to jump. And I will tell you that if it makes a $5 move tomorrow, you're going to be able to look what it could be. This kind of a move from 200 to 210. Hey, this one day was a $10 move. You know what kind of frog trade that was? Easy. Because you have a 70-cent frog box on that thing approximately. And it had a one-day move like this. And look at this one-day move. And here's what it did Friday, this tiny little coiled spring. And if it takes off and goes, and it gets above this, off it goes. So I'm just saying, that's how you structure your trade opportunities for one-day big pops. And then you could do the following. Hey, what if I actually made money on that tomorrow? Let's say it did have a nice big move, and I'm able to make some profits on that intraday move. I could just hold. I could sell 80%, put that in the bank, and make bank, bing, and then keep 20% for the overnight risk. And then the next day, if there was a second day of follow-through that looked like this, you could see eventually over 10 days, that thing could turn into a nice 10-day swing trade. And so all you got to do is use markets money to fund the overnight risk. Then pretty soon you can just leave that swing trade on, all with markets money, none of your seed capital at risk, and off you go. So all you need to know on that one is how to structure a mechanical entry with a mechanical stop. You don't have to read any patterns. You just have to look at the framework and put your little trade frame together real quick. You can put your complex orders in ahead of time and just take the ones that fire. So now if I come back to this daily squeeze, and this is just inside the Dow 30 and the ETF 100. You got General Dynamics, Google, Amazon, Honeywell, Costco, XLY. XLY. You have That's the, I think it's the healthcare sector spider. You have IYR, the U.S. real estate. Well, 3.5, Robert, is, that's the ATR in that thing is relatively large, but your intraday risk is probably only a quarter of that. You only need 70 cents because once that thing breaks out above yesterday's high, you're in. And then if it turned around and made an adverse 70-cent move against you, you'd be convinced that it was a false breakout, and so you would get out of that position. So you're risking 70 cents on the downside for the opportunity to make $4 on the upside on an intraday move that's not even extreme yet. That, to me, is the working definition of a low-risk idea. Yeah, and ATR is definitely a low-risk idea. Dave says, I think I get the selections. You've been selecting the common targets you trade, not the ones with the highest number of R&R. Yeah, and all other things, I will tell you, Dave, on any given day, all I did here, this is just the Dow 30 and the ETF 100. If you open this up to the S&P 500, you can find things with 10 to 1. And I just say, in a target-rich environment like that, what's my hurry? What's my worry? None. So I just look for things that I know. I would say, oh yeah, Google, I know that one. I know Amazon. I know Honeywell. I know Costco. I know the S&P sector spider for healthcare, for crying out loud. And I know Disney, and I know real estate. There's 7 things that I trade on a frequent basis that are all setting up very well. And all it has to do is take out yesterday's high, and I know that I can be in with a low-risk idea. So you could try to over-optimize this by starting at the top and working your way down, or expanding this to a very wide sector. But I sort of take the lazy man's approach that if I'm trading things that I already know and feel comfortable with, my own personal level of stress is low, and it would be harder for me to lose my mind. I'm not saying that a young man like Patrick Birch couldn't handle more excitement, but I don't need to. I'm very content just staying with these big fat cows that I prefer to trade, like the Dow 30. Yes, Lisa. I use the mechanical entry is how I'm computing this, with an ATR of 1 as a risk. Very low risk idea. These are all poised for large one-day pops. All right, so this was almost 90 minutes of unprogrammed presentation. The idea for this week's homework was that you were going to look at those charts and see if you could figure it out, but I guess this just actually made more sense. What I'd like to do is I'm going to postpone the presentation I was going to give you on teaching, coaching, and mentoring, although it is a freaking awesome presentation. But it's not as important as about what we're going to do next, which is to look at the trade frames and get you out of here in 30 minutes. But it just felt like to me that this was 90 minutes that was worth sharing, and 90 minutes to just get it documented and be done with it. So I would like to give you like an 8-minute break, and then we'll come back, and then I'm going to go right to the trade frame. I'm going to hit some of your homework stuff, and then the trade frames to get us out of here on time. Okay, so let's take 8 minutes and recharge our beverages. The other thing about having an 8-minute break is when I go to the recording, the logical place to make the break in the movies is very clear because there's an 8-minute gap of silence as soon as I stop talking. So I'll be back in 7 minutes. Nice. That was within a quarter of a second, 226 thousandths. So timing was okay. Okay, so we're back. Let's see here. All right, so their homework for the week ahead then, identify your high payoffs. Listen to these videos as recordings as much as you need to really get your arms wrapped around the fractal framework and the squeeze. Those are nice, relaxed strategies for getting into positions. The videos we should have watched this week, these are ones that really were pertaining to the particular patterns and how they operate. What we have for the week ahead is there's like 4 RLCO case studies in there. I gave a short presentation to my doctoral students about coaching, teaching, and mentoring. And I'm going to let you listen to that one. I was going to cover it tonight, but I'm going to let you listen to the draft. I think I'm going to redo it and hang it because it's a really good briefing. And I have some things to say about that. And then the weekend report. If you're if you've already done all the ones from last week and then you get ahead of these and you want to read ahead, there's some more strategy-based things we're going to cover next week. These are more, so the RLFF and the daily squeeze are strategies in much the same way that green, yellow, red trading is in auto framing and the ready, fire, aim technique. But those two right there, the squeeze and then the regression fractal, are my two best strategies for swing trading right now. So I wanted to front load some of that. So that's what we have in terms of homework in the week ahead. Again, make sure that you get your big 5. That's the best things, hardest things, aha moments, best takeaways, biggest unanswered questions. and then update your goals, and then those two discussions we just had. Make sure you get those things locked in. And then again, if you have any questions, get them posted on the right board so that I can cover those when we, in the following weekend report. Okay. Hey, this is just some things to catch you up on. This comes from Goodlow Sutter, very good friend of mine, guitar player, artist, good trader, good person. He was in Unitarian Church, and they were talking about the 12 qualities of spiritual maturity. And he thought about us and our efforts, and he said, there's a lot of trading quality in there. And this came up in a discussion with in the coaches roundtable this weekend with Kieran and Catherine. And it was just amazing how things kind of come together. Kieran said, hey, when I started learning this stuff, I thought I was just going to learn how to trade, and it turns out that I'm on this lifelong quest of self-discovery and development. And when he made the point that the market makes you handle your stuff. It finds your stuff, however deeply it's buried, and it makes you handle it. And here's why I think that's the case. If you master your emotional state, you become a very quiet pond. It actually only takes a very tiny pebble to create waves that become noticeable. So even if you master that spiritual state of nothingness, it doesn't, you are tempted to move out of that state even at the smallest of distractions. And the reason the market does that for you is because the margin between success and failure in the market is very small. It's just that hard to do. If you think about the casino, they have a 2 or 3% edge, 2% edge on blackjack. So they get a 52% win rate, 48% loss rate, but it's locked in. And so they can do 1 billion iterations. And so because of that little 4% edge, it's really a 2% edge. It's tilted in their favor. Works out to 4. They have a, oh, no sound. What? Testing, mic check. How about now? Okay. Yeah, Robert, it may be on your end. So there's only a 2% edge in the market for blackjack. And so in order to in order to win, what the market has to do is hunt for those little triggers inside you that make you not follow your rules. So if you've got a good set of rules, you're like a quiet pond. You've achieved stillness. It only takes a little bit to bump you off that. And then it's a big win for the market. So our mistakes tend to be bigger than our average wins. So the market has become this hunter of your weaknesses. And so it does a better job of finding your weaknesses than you can do of hiding your weaknesses. So we get paid to check in and check ourselves and deal with our stuff. And so Kieran's insight was the market makes you deal with your stuff. So in a conversation I had at breakfast with Patrick earlier this week, which was enjoyable, we're going to do once a month, we had this idea about the Niken philosophy that looks something like this. That inside the dojo is where you go naked and unafraid with your sword to engage the market. And what you have to do when you cross that threshold into the market is you have to leave all your thoughts and feelings outside. And when you step into the threshold, you are in the zero state, naked and unafraid, hands on your sword, ready to deal. That's the zero state. Now, what I want you to notice is I'm not saying that you have to process all your thoughts and feelings and then achieve the zero state out here in the antechamber in the warm-up room, and then when you're in the zero state, enter that room with all of your stuff dealt with. What I'm saying is, when you're trading, you've got to leave that outside of the trading room. Deal with it some other time. So you don't have to make yourself perfect and then go trade. All you have to do is commit to not taking thoughts and feelings with you inside the room, and all you have to do is execute your rules. And you don't go into the room until you're prepared to execute your rules without thinking and feeling. That's what the zero state means. That's what Nikan philosophy is. Nikan philosophy of living says, look, you can't control your feelings. You can't even manage them. All you can do is feel them, so enjoy it, and that's how you know you're alive. But don't let the feelings drive the car. Don't let the feelings swing the blade. And your thoughts, you can't control them either. You might be able to manage them a little bit, but they come into your mind without warning, nominated by your gut, which pushes up the 7 things into your head to consider that are arising out of your subconscious. So you can't even control those. And the Nikan philosophy says, I actually don't even care what you think or feel. It's what you do, because the action that you take is your responsibility. Your action is your intention. It's your choice to act or not. You can't absolve yourself of that responsibility in reality. It is your responsibility as an adult. And so Nikan philosophy says, deal with your stuff, but when you cross the threshold and decide to trade, you must be in the zero state, naked and unafraid, for as long as you can stay there, and then back out of the room. And then deal with your stuff outside the room, in the practice area, in the warm-up room, in the workout room, in the library, on a long walk, whatever you got to do. Deal with it out here, but not when you're trading. Make that deal with yourself. So that whole mindset says, hey, I don't have to wait till I have become perfect in thought and feeling, because I don't even know what that means. And I can't control that stuff anyway, but what I can do is I can be perfect about not bringing it with me into the dojo when it's time to trade, when it's time to deal. Naked and unafraid. Hold the sword. Make the trade. Stay there as long as you can. Leave before you leave the zero state. So get out before you're out of juice. So I say all that just to say, then Goodlow sent me this thing, the 12 qualities of spiritual maturity, and these were things that help us become adult in the course of our living and dealing with exactly these kinds of thoughts and feelings and our standards of practice. I just thought the ability to be in the presence of pain without panic, that's what being in the zero state in the dojo is. I'll feel the feelings and think the thoughts later. Right now I'm trading. Being faithful to your purpose. Support beauty, mercy, and justice for others and yourself. Ability to acknowledge error and change. Serene surrender to a reality. What I would say is acknowledgement or acceptance. I can live with acceptance. I suppose I understand what surrender means. It says the acknowledgement that reality is bigger than you. I accept that. Universal connectedness. Here's 3 examples of how these ideas come together. Yeah, exactly, Robert. Feel the pain, but do it anyway. That's all the Nikan philosophy says. Yeah, so what? Everybody's in pain. That's what living is. How do you act when you're in pain? Do you use that as an excuse not to do the right thing, to follow your rules? That's what it is. A perspective of gratitude, wonder, blessing, and generosity. That's the owl meditation. Fluency in the use of metaphors, the connectedness of things. Be willing to lead and also serve. That's the essence of our coaching and collaboration and partnering, is a combination of teaching and learning and supporting each other. So I just offer that to you. I'm going to hang these slides in the base camp area anyway, so you can reflect on those. This week was really to reinforce the idea. If you get the market call right, you got 50% of the battle right there. We identified the market as And Lisa did a beautiful job of this. Hey, it's bull. I mean, it was a bear normal, but it's moving towards sideways, and the volatility is draining. Maybe this is not the time to be taking those overreaction swing trades. Exactly right. The slope of the 270 was different for 30. It was telling us that the market was in a state of transition. She described it perfectly. I'm going to show you how she did that. So if you get that right, it turned out that EWZ, after being 3 years the punching bag for the market, was massive, up 15%. And so we can catch that. And XIV was working while TLT was giving up the ghost. XLE started to turn. Materials were kicking ass. So this was all about getting the market call right this week. And everything else is gravy. And so when you listen to the weekend report and I talk about the market health check, that's why the first thing I always do is talk about the market health check. What I want you to notice is on the slope stat that here's where the market bottomed out. Here I'm highlighting this is the moving value of the slope statistic. Down here at the bottom, it was at minus 0.75. When it gets below minus 0.22, it's statistically significant as weak. When it gets above 0.4, it's significant on the upside. And so in the course of the last 30 or 40 days, this thing has gone from minus 0.75 when it was this 30 period. That was horrible. That's a terrible 30-day period. In the last 30-day period, it's all the way up here, guess what, at 0.40. This is the upper end of normal. Now, it can get better, and it will once it leaves this stuff behind and just keeps going. This thing could get really good. And it went from horrible to very good in the period of just 30 days. And that was about a 10% move off the bottom. 10% move off the bottom is what that triangle looks like. And the slope statistic was a reliable guide about that change. Now I want you to notice that whole period of time we were in bear markets because we were more than 2% below the 200-day moving average. And that's pretty good for weekly and quarterly and annual market classification. But for swing trading, what you had was 3 distinct moves that a swing trader could take advantage of. The big move down, the sideways chop, the big move up. 3 different market conditions, all very well described by the slope statistic. And look how quickly it told you right here that we're entering a period of potential weakness because the slope statistic just got below the 0 line. It gave you this much warning. It gave you 20 days of warning before the collapse occurred. And down here where it started to get a little bit better, it said, hey, the market isn't getting horrible. It's now chopping around. Be ready. And then here is where it went above the 0 line, and it gave you the opportunity to participate at least in 10 days worth of upside. Pay attention to the slope statistic as a way to fine-tune your understanding of market conditions for swing trading. Can't say it any clearer than that. Here's the picture of it on the daily. That's the 30-period regression line. This little polynomial regression line just shows the acceleration. It's looking good. This is where it turned. It crossed its own 10-period moving average. It's done nothing but improve all the way. Look at this clear moves in the slope statistic. That's what it looks like without all those candlesticks on it. You got to be able to trade that for swing trading. Look at the different moves that it gives you. All very, very tradable on a swing basis without intraday optimization. In the interest of time, I'm going to blast through this stuff pretty quickly. Here's a longer-term historical perspective on just how significant that change in market conditions was. This is looking back at that slope stat of the last 10 years. It was the second worst period in the last 10 years. That's how bad it was 30 days ago. And now it went from minus 3 sigma all the way up to plus 1 sigma. That's how much that thing improved, going from here to here. This last one that it sold off in October, that's how steeply down it got. So when that thing makes a rollover, crosses its own 10-period moving average, more than 1 SD from average, pay attention. Look at the volatility draining out of the market. It's now down to historical norms. That's why we're sideways normal right now. This is how good the moves have been lately. These are all these swing stats. That's what I'm going to call this, the swing stat. And that is for these 40-day holding period, the 20-day, the 10-day, and the 5-day for all the usual suspects. This is the standard deviation, or the Z-score of each of those moves. On the S&P, the 10-day move is 1.16 or 1.14 advantage. Look how strong the move in Latin America has been. It's a 3.5 sigma move over the last 5 days. It's a 2.9 sigma move over the last 10 days. That's a good one to study. I'm going to give you a spreadsheet that lets you do that for all your symbols, not just the ones that I track. That's going to be my gift to you. It's called the swing stat. Still building. You combine that with the RLFF, dude, I think you got everything you need. I'm going to cover this anyway. This is just too important, so just bear with me. If it takes a little bit, so be it. Look, when you're the master craftsman, and you're trying to teach the new person. We've all been this guy. Look, you just came out of the bookstore and you got all your books and tools and tool belt, and you're confused about the class, and you haven't done the readings, you don't know what's going on. You've got the same stuff that this guy does, but you haven't got it organized. You haven't made it your own. And all we're talking about here is making bowls. This guy knows how to make the bowls. He's made 1,000 of them. And so when that craftsman tries to teach, he's talking about the bowl over to this guy, and he's seeing the bowl from this side, and after 10,000 iterations of bowl making, that's what he's trying to tell him with words. And he's using the words that make sense in his own head, and those words probably don't make sense in the same way because they lack the experiential grounding of the guy that's on this end. And so if this guy feels frustrated, it's because he's frustrated that, hey, my words don't work for you because you don't have my experiences. Well, of course it happens that way. That's what being human is. So the reason to teach is when I can stop talking about the bowl, but just move over to here and get on this side of it with you and say, now, let's together look at this bowl from your perspective. And this is what I see. What do you see? And then we compare our notes. And then in that process, together, we can collaborate to understand something about that damn bowl. Well, that's how we get the knowledge transfer from the master to the apprentice, and he becomes a journeyman. But this is an essential insight. This is how the journeyman becomes a master, is by trying to explain in a different way. So now I not only see the bowl from my journey and I remember all the things that as I was making my progression from apprentice to journeyman. Now by adopting this role, I can now see it from another way, and now I have two different perspectives in my mind, And I now have a three-dimensional understanding of that bowl because now I've gone all the way around the circle and back again. And then in the act of teaching, I help you get to this side of the bowl, and then I may be able to ascend to the level of master craftsman. That's what craft knowledge is. That's what Mintzberg says management really is it's not just the science and the rules, and it's not just the intuition, but is the accumulated know-how of craft knowledge that comes from reflective learning and this collaboration so that we can find this sweet spot between the science, the art, and the experiential knowledge which we put into words that creates the enlightenment and document it, and then collectively we may aspire to craftsman status. And so I love this organization. The name of it, the Guild of Master Craftsmen. That's what we're trying to build here. It's all about just making the bowls. And so when we get into our little coaching groups and partners pair and share, what we're doing is taking advantage of our multiple perspectives and trying it on for size and trying to find the words that work for us. And then through this collaboration, we may be able to clarify what it is we mean and then aspire to mastership. So the role of the assistant coaches in our coaching is really important because they've been through one cycle of this already. And then our crosstalk, and then maybe with me so I can clarify my ideas a little better, is this interchange makes us all better, and we can all move forward together towards this desired goal of master craftsman. I hope to be a master craftsman someday. That's my intention. Each day in every way, I try to take on the student, the teacher, the mentor, the coach role as a way to improve my practice and your practice so that we can get well together. That's the main point of this idea, the Guild of the Master Craftsmen. I love that. Well, let's think about what we're trying to do in these terms. I would describe this variously as the virtuous network or the community of practice. As we engage with our professional body of knowledge, and Catherine's doing a massive job of trying to collate this stuff and turn it into English. So we have our experience of learning. This is a network, by the way. This is not a one-way path, but these things are connected. When we document our experiential learning and we teach each other, coach and mentor and partner, and we develop our lesson learned journal, hopefully you get inspired to come to the research weekend and have a lot of fun drumming and eating barbecue and present your material and listen to others, but or participate at a distance, but somehow engage. That's sort of a peak experience for getting this stuff together. But the lesson learned journal really consists of the three parts: the self, the system, and the market analysis. Any or all three of those are things that can be talked about at the research weekend, by the way. Putting in my plug for the research weekend. But it's this active analysis and then the reintegration into the holistic person. Because remember, it's you going into the dojo naked and unafraid with your sword to trade. You got to do the individual analysis components and then reintegrate it. And then that cycle leads to improved trading practice, which happens in the dojo and in your trading rooms and around and in your platforms, which gets documented. And so you get this virtuous circle. And then it is this community of practice that collectively and individually, but also collectively, we teach, coach, mentor, and partner with each other, and it improves each and every part of these, because teaching, coaching, mentoring, and partnering happens for all of these parts on the potter's wheel. And so the Guild of Master Craftsmen that we're building here really takes into account all of these components. And what we're really looking to do is to be excellent in everything we do, to act intentionally with the goal of excellence, accepting where we are, committing to do better together and as individuals in support of our common and then individual purposes. That's how all this stuff ties together. That's what we're doing here. So here's what I learned this week. You're just going to have to bear with me on the trade frames. You're just going to have to bear with me. These are too good not to share. So sorry. Patrick really has to suffer because he heard this twice at breakfast. So I had that conversation I just had with you, I had 3 different times this week. Once with my military guys, once with my doctoral students, and now with you. And what happened was, I talked to the military guys about the problem they were having understanding stability operate. They know how to seize the hill and win a fight. They don't know how to make peace in the valley. And so our doctrine is very poor, but it talks about lines of effort. It says you have to do 5 things to bring peace to the valley: governance, security, law and order, build infrastructure, and then support an economy. They brought in their old mental models of certainty in planning, decisive operations, and unit of command, and found it doesn't really work. Because to build peace in the valley, you have to build a community of practice. You don't have to fight and win a war against an enemy. You got to build coalitions of people and help them find their commonality and to build trust. And so by using a financial metaphor, I told them this is how traders, how you and I think about financial stability operations and making peaceful prosperity. This is how we think about things, and you're going to find that you can apply this in making stability happen in nation building by using action learning, which is what we just described in that virtuous circle. But it's not about finding a decisive operation, but it's about building structural integrity. When you build a house, you don't have a decisive operation. You don't say, what am I going to aim for excellence in? The foundation, the walls, or the roof? Well, a builder will tell you, you're nuts to think that way. What your house is as good as the weakest element of the foundation, walls, and roof. So you have to be excellent in all 3 of those. And the one that is the weakest, or what Kieran would say, whatever your stuff isn't handled yet, that's how good you are. And so what you got to strive for, instead of domination, you have to find balance and inclusion, and then treat stability like portfolio risk management. So we said, what does that mean? We said it means the following things: that traders think about lines of operation in asset classes. They think of asset classes like the military guys think of lines of effort. These are stocks, bonds, equities, currencies, commodities, whatever. And that instead of planning and decisive, we think about trade framing for risk management, allocating assets among these asset classes, and then watching for the dynamics of change and correlation to make sure that our relationships between the assets are still understood and that we're making good trade-off decisions. And so this is what we do, and this is what I taught the military guys to do this week. The first thing you have to have is the ability to manage risk to a 1R level so that it doesn't get out of control. You got to be able to estimate 1R and then manage to it so it doesn't go viral, and 1R loss doesn't lead to the complete destruction of your entire portfolio. And we think of that as a firewall and compartmentalization, so independent trades. Then you got to care about the payoff histogram, and that is, what's the payoff matrix look like? Here's one that's symmetric payoff and zero expectancy. The average is 0. Coin flip gets you this tail on the right, and it's the same as the tail on this side. So it's a coin flip. I could win 1, 2, or 3, or I could lose 1, 2, or 3. There's no advantage. Now, the casino only has a 4% advantage, and then they charge you 10% of a VIG, and that's how they shift it to an asymmetric payoff. But what we really look for are asymmetric payoffs. We want this. First, we want no losses greater than -1, so we cut off the left tail. Then we want a normal distribution between -1 and +2 that is positive expectancy, and it looks like a normal curve. So this is lots of trades between -1 and +2 that have positive expectancy. And then number 3, we look for a fat right tail. That gives us an asymmetric payoff. And that gives us positive expectancy. And then over time, our job for systems management is all about taking the model that we just built and saying, is it still behaving that way? So we care about stationarity. How dynamic is the shape of our histogram? Is it changing or is it stable? If it's stable, it's said to have stationarity. If the shape of our curve changes a lot, then it's really out of control. We haven't identified all the variables. That lack of stationarity is systemic volatility. That's bad. So what we have to, if it is a good system sometimes, we have to measure that and monitor that payoff matrix and know when it's time to stop trading that particular system. And then expectunity is nothing more than however stable your positive expectancy system is, how many times a day, month, year can you play it to give you the expectunity. And then we take that expectancy and then we put the performance limits on it that tell us as long as it's between that green line and red line, it's behaving as it's supposed to. So that's what I mean by payoff histogram. Now, what we look for are, if we have an individual trade, I want to say, and it works, I say, can I scale this? Can I get larger? Can I grow my position size, or is there some upper limit to how much that market will bear? I prefer things that allow me to scale. Maybe that's adding to positions. Maybe it's getting larger and growing the position size. So the things that look more like big fat indexes, the easier it is to scale. Leverage. By that I mean, is success in one trade now leads to potential other opportunities. In the stability world, what that means is if I educate people in the allied trades, I now have a pool of trained electricians, plumbers, welders, and then I can create secondary service and construction jobs that build on their success, and now I can create opportunities for even more payoff that I didn't used to have because I invested in things that have leverage. They can lead to more and better opportunities. That's like if I get SPY correct, and that leads me to XLK, I now have the ability to get tech, and now I can go to IBM and Apple. Each successive piece of success leads me to more and more opportunities that have greater leverage and return on investment, which I can use with markets money. That's what I mean by leverage. Continuous improvement means that I am committed to finding ways to improve my expectancy and to minimize the amount of downside risk that it takes me to be convinced that it's out of control. So continuous improvement. Each day in every way get better and better. Don't wait till you need to get better to start getting better. Do it all the time. And the way to do that is through this plan, prepare, execute, assess model that we just described in our virtuous circle. These are the things that make us successful traders. These are the things that I'm teaching the military guys how to do. And the reason they can understand it is because I have eliminated all the noise of what they used to know, and they're looking at this stuff fresh, and they can see the general principles, and now they can bring it over into their world and make the changes. In the same way that when I use a military model to explain things to you, it's so that you get out of the detailed noise that's confusing and just understand the central idea. The central idea here is that both of these domains have the same problem. It's this problem. And if we treat it like portfolio risk management and understand the nature of that problem, and it's expressed right in this box, then we're actually better at this and better at that. That's the reason you triangulate. That's the reason that we collaborate. That's the reason this model works, is because we're looking at the elephant, or in this case, we're looking at the bull from multiple perspectives, from his perspective, from this perspective, from that perspective, from this perspective. The stories we tell over time on the 1,000 iterations, all of those things give us the deeper understanding for many dimensions, and we can begin to approach deeper understanding. That's what I learned this week. That's a pretty good lesson. That's why it's worth doing this stuff. That's why it's worth collaborating. So, Yasek's insights. This is what acceptable homework for that 0501 looks like. Best things, hardest things, aha moments, best takeaways. He's getting it. He finally says now, I finally understood keeping the intraday turbo position overnight. That tells me we're starting to get it. Dave's outstanding work. Read his stuff in detail. This is what excellence looks like in documentation. Some things I would highlight. The zero state, naked and unafraid in the dojo with the sword. Skill, not knowledge. You don't need knowledge in the dojo. You need the integrated skill that leads to intentional action without thinking, without feeling, without fear. The environment, the circle of practice. Get into the habit of trade framing, house of trading and building. Risk Z and the slope of the 30. The answer is yes, they work the same way in Australia. Yes, you can go into the coaching program. That's what you're in right now. We're just going to keep going. The swing systems work now and will continue to work because of large cap volume, because they all behave like big fat elephants. And I will introduce you to Mike Dungy, who's going to give us a presentation about how he's doing this in Australia. It's very persuasive. Tell me later what you mean by the pop page. I'm not sure what you mean by that. This is from Jeremy. Not quite the same format, but it has all the right pieces. And you understood this idea. The centerpiece is the river of risk and the stepping stones across it. And you've identified the key elements of that. The techniques, the max pain range compression, the frog, the RLCO. These are the stepping stones that get you from yourself into the land of milk and honey across the river of risk. You've identified that correctly. I approve these tasks for next one. I would just tell you, put on 10 trades properly. It's okay to shoot for an average profit of 100 each, but I'm more concerned that you get the muscle memory. I don't know that all 10 will work, but if you put them on properly over time, they will. Very good use of the learning journal, so keep that up. Synthesize that into the way Yasek did for his best thing, hardest thing. Look to make that connection to shape your goals for the rest of the course. Lisa, nice work in here. I was not able to open the text that you provided me because it's an Apple and it looked like just symbols. This is the things that from your February 26th journal entry that tells me you're getting it. We're in a bare normal market but steadily approaching sideways. You realized that it was the approaching sideways that mattered. It wasn't just normal, it was getting better as the risk Z was improving. I'm not sure waiting a few minutes in the market gives me much information if I'm planning for the 10-day SMA. What it says is you can think about it, but be careful and be ready to cash exceptional performance over 1 or 2 days because we are still in bear or sideways. And you make a very good point here that when we're steadily approaching sideways, maybe I shouldn't be planning to hold the trade overnight. Maybe I should just be looking to exit end of day This leads you to swing trading one day at a time, using the swing trades as a signal generator. Slope and position of the risk Z not only might be, it absolutely is useful. And it will absolutely answer this question: should I hold positions overnight or over the weekends in an improving bear market, knowing that that's when that sudden snapback puts us at risk? I agree with this. No swing trades OR short when the risk Z has been going up. That tells you when to fine-tune the signals. And I see that in your words, based on your analysis, and not because you're listening to me, but because you have internalized this stuff. That's what you've got to do. And so I think you're reaching a tipping point. But remember what I said last week about the tipping point. That's not the moment of freedom. It's the moment you got to watch out that you don't go over the hill and get too aggressive because of the breakthrough. It's a chance to add one more tool to your arsenal, to your toolkit, and then drive on. So well done on that. That's everything I wanted to cover. Those were the pieces of homework that I saw uploaded that I wanted to highlight. Very important stuff. It's going to be pretty easy to look at these swing trade frames because we're looking at the same symbols, and there was probably 20R available from the swing trades we did from last week. And so I'm just going to go right through them real quick and just show where we are in all the trades. There's not much framing and trading to do because it's really straightforward. So this, I'm going to break this into the third part. I want to keep that middle piece available. That turned out to be a pretty good hour as well, I think. So this is going to go pretty fast. Here, so this is Apple. That was the entry. It went up to the 270 and beyond. The Z3s are starting to expand. I'm going to move my stop up underneath here. This thing's just going to go. So that swing trade is good to go. And now with turbo, it's even better. Look how nice it is to turbo on a day when it really goes, when it breaks out of the river. What a beautiful turbo day that was. That was $4 of a move on a position where you already had 2 days market money in hand. That's when you turbo. That's why you consider that as a technique if you want to do this full time. AXP we've already seen. Here is our, this is our entry. I mean, off we go. There's the 270. We're in 1R into this thing. Don't let it turn negative. But the 30's getting ready to leave the river. That's the beginning of trending behavior. 6240's in hand, or in sight. Caterpillar, up and away. Here's our entry down here at 67 with a $3 stop. It's at 72. This is 2R in hand, and off we go. So manage the trade. The target is up here when we look at previous support and resistance. So let's look at that real quick. We're already there. This is the next hump, and this is where the first collapse. That's where it's going. All these things, that just tells you I trade this thing a lot. But this looks good. Caterpillar looks really good. Chevron. There was no trade in this thing. DuPont. Here was our entry. We're about half 0.4R in hand. Moving well. Nothing special. Managed to trade. Diamonds. Got a good entry 4 days in a row. I'm going to move this to no lose plus dinner for 2. So don't let that one escape. It should never go negative on you. Disney. Good entry here at 96.60 last week. Looking for 103. Good to go. For Sanal, good entry in the Dow. We're about 1R in hand. Here's the 2R gain. Devon Energy, got our nice entry. It's at the 270. It has to get above this hump in the frog, or in the dragon. If it does, then it goes to the next hump, which is at 33. So cautiously optimistic. I will not let that turn negative. Emerging markets, awesome. Look at this. Up, up, and away. There we go. Manage the trade. That's 3R in hand. Don't let it escape. Mexico moving out nicely. Easy. Brazil, 15%. Yeah, baby. Yeah. That's why we play this game. Facebook, nothing. It's dead money. Rotate that money out of there. It's not following through, and I had a bad Friday. I'm not long for that one. China, we're 2R in hand, and all systems go. Gold miners, I have no trade on this one. I felt it was too late. I'm worried about it. No trade. I'm not going to start a new position. Gold, same thing, no trade. Oh, as you were, we did have a trade from earlier. This was from back in February, but not during our swing workshop. So I have no trade in from the swing workshop. Goldman Sachs recovering nicely from the double bottom. We're about half an R in hand. There's the 1R. That's my initial target. Don't let that one turn negative. Latin America plus 15% up, up, and away like Brazil. Russell small caps, look at this sweet. Oh, 2R in hand. And now I will add a second position and micromanage the heck out of this one tomorrow. U.S. real estate, marking along at 2R. I'll add another position up here. Don't let that one go negative. I'm going to keep at least 1.5R on that one. I will probably move my stop up to a 2-day low and just trail. JP Morgan, no trade. Coca-Cola. This is one where we got the entry here. We went underwater to a half an R. We're in the money now, but it's not much. It really has to get above 44. If it doesn't, that's when I'm likely to cut. McDonald's. Also like Coca-Cola, we got our entry here, but we're just about at break even. That's one, it's dead money. We'll see how it goes. Microsoft, almost dead money. It's only at half an R, but the 270 is up, so maybe there's some momentum possible in here. We'll see. Nike, we got our entry. We've had 5 days of selling off. If it shows any weakness tomorrow, I'm cashing a half an R. Procter & Gamble, nice. We had sideways, and it just took off. I like this one longer term. Let's manage that one. That's one I would give it some room to run. I didn't have a trade in tech. The market, SPY, feels good, up, up, and away. Treasuries, we took a 1R loss this week. That's the only losing trade. Tesla. We got our entry here at 168. We're at 204 on a $20 stop. So it's 2R. Off we go. United Health. We got our entry in here. We're at break even. If it gets above that purple line, you may recall, that was like an all-time high. If it gets above there, off we go in healthcare. Oil has had a nice recovery this week. We got our entry down here at 8.6. It's at 9.6. That's a 12% gain. This is a 1R in hand. It's at long-term fair value. This is where this could be a bottom in oil down here. United Technology, I just missed that trade. Verizon, got our entry here, half an R in hand. That's a relative strength leader. Walmart, got our entry here. We're about 3/4 of an R in hand. It should be able to go here. If it hesitates and the market's weak, I'm going to cash that one. Win. Oh, this is so full of win. We're 3R on this one. This has been great intraday trading with the hybrid frog. Off we go. XIV, the lack of volatility, is looking good. We got our entry at 19. It's at 21.5. I'm not going to let this one go negative. I'm going to use a 2-day low on this to protect that position, and I'll be ready to turbo it. So my stop is going to go up to here. The rest of them are the XL series. Materials are awesome. Energy, awesome. Finance, awesome and getting better. Industrial's looking good. This is a broad-based recovery here. Technology, consumer staples looking good. Healthcare, sputtering but getting better. Consumer discretionary looking really good. This was one of those, that little daily squeeze that's looking fine. We did manage to get XME back on. Remember, I felt like I had missed it because of this long move here. Well, we went ahead and got it anyway at 1680. So that's on $2 of gain on a dollar stop. So that's 2R in hand and looking good. So it may not ever be too late. Who knows? And then the final one, ExxonMobil, there was no trade on this one. So, yeah, Lisa says, hey, trades you had this week, too nervous to hold with the volatility in the mornings on Friday. Nothing wrong with that. There was a lot of, you were able to cash some good things. I just think this week ahead has the potential for some real goodness. We're starting to get some clarity in the political events, but I keep in mind that there's no hurry and no worry. We're at the 200-day moving average. We've got about, in the swing trades right there, I'm looking at about 20R in hand with only one loser. I'm going to make sure that I let the winners run. I'm going to focus them. The swings now got us out of that hole at the turning point in the market, and we got that first easy move. None of them are easy, but the first move off the bottom. And now we're at a critical state in the market as it has made a 10% bounce off the bottom. It's near the 200-day moving average. It's 5% away from the all-time high, but it is an election year. And this has been an extraordinary 30-day move. So this is a natural place for it to pause. Anything can happen from here. Manage your risk. Study the material. When it's time to trade, trade at a level that allows you to trade without fear so that you can make your decisions in the moment without regret or overthinking or overfeeling. You have to enter the dojo naked and unafraid and hands on your sword and trusting in your kata, trusting in your preparation. Preparation is everything. So we're right at that critical state in the market. Way to hang in there, guys. We went to 2.5 hours today. You're doing a lot of great work. Keep it up. Remember that virtuous circle, the community of practice, trusting and collaborating with each other, documenting, moving forward. And remember, there's only room for two hands on your sword. They're yours. You can train with your partners and help each other out in the practice rooms, but it's you in the dojo when you enter the battle circle. So be naked, be unafraid, be prepared, trust your heart, and strike to win. That matters. Please take good care of yourselves. Eat well, sleep well. Share everything you know with everybody. Pay it forward. Never leave anything unsaid. Tell those you love them. And let's just get on. Let's get on with it. And I'll see you in the chat room. And during the week, I'll update these swing trade patterns and whatnot. And I'll get these movies processed and hung. Keep up the great work. And let's just keep going. That's all I have. Any final questions before we cut it? If you have questions, send them to me. This feels like a natural place to cut it. So, and then off we go. Well done, guys. Keep going.